What's up traders? Welcome back to the channel. If you've ever looked at the depth of market or DOM and thought, what am I looking at? Or you have no idea what the DOM is? Don't worry, I got you covered. Today we're breaking down how to read the DOM and use it to spot liquidity, order flow, and key trading opportunities in the futures market. By the end of this video, you'll know how to understand the bid and ask ladder, identify real buying and selling pressure, and use the DOM to improve your trade entries and exits. So if you're ready to take your trading game to the next level, smash that like button and let's dive right in. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Alright, so what exactly is the depth of market or DOM? The DOM, also called the order book, shows us real-time buy and sell orders waiting to be executed at different price levels. Now, if you saw my previous video, we went over those different order types. If you aren't familiar with those, you should definitely go watch that video first and then come back to this one. On the left, you'll see the bids, buyers willing to buy at a lower price. On the right, you'll see the ask, sellers willing to sell at a higher price. The center is the last traded price, where the market is currently trading. The DOM is crucial because it shows us liquidity, how many contracts are available at each price level, helping us see where buyers and sellers are stacking up. Now that we know what the DOM is, let's break down the bid and ask orders. The bid column, or the left side, shows buyers placing limit orders below the current price. The ask column, or right side, shows sellers placing limit orders above the current price. When a buyer aggressively wants to enter, they'll buy at market price, hitting the ask. When a seller aggressively wants to exit, they'll sell at market price, hitting the bid. This interaction between bids and ask moves price up or down. And by watching where large orders are stacking up, we can spot potential support and resistance levels in real time. Okay, but how do we use the DOM to gauge market strength? Here's how. If you see a lot more buy orders, bids, than sell orders, ask, that could indicate buying pressure. Price may go up. If you see huge sell orders stacking up on the ask side, that could indicate selling pressure. Price may go down. If the bid sizes suddenly disappear, it means buyers are pulling liquidity, possibly signaling a reversal or a drop. Also, now you have to be careful and watch how the DOM is moving. Just because you see a lot of orders on the ask doesn't guarantee that price will drop. Sometimes these orders act as a magnet, and price will move in that direction and lift those orders off the books. By watching how buyers and sellers react at key levels, you can potentially predict where price may break through or reverse. Now that we understand the depth of market, let's talk about how traders actually use the DOM to enter and exit trades. The DOM isn't just for looking at numbers. It's a powerful tool that can give you a real-time edge in trading. There are three major strategies that traders use with the DOM: scalping with order flow, breakout trading with liquidity disappearance, and reversal trading with absorption and iceberg orders. Now let's break these down one by one. Scalping is one of the most common strategies using the DOM. Scalpers focus on very small price movements, getting in and out of trades quickly, sometimes within seconds. Here's how scalpers use the DOM. They watch for imbalances between bid and ask sizes. If the bid side is significantly larger than the ask side, that could indicate buying pressure, potential for a short-term pop in price. They look for market orders hitting the bid or ask aggressively. This is known as market order flow. If large, aggressive buyers keep hitting the ask, it could indicate short-term bullish momentum. They enter trades in the direction of order flow and quickly exit when price moves a few ticks in their favor. For example, if you see 1,500 contracts on the bid and only 500 on the ask, and you notice market buyers aggressively hitting the ask, you might enter a long trade aiming for a 2 to 3 tick move before exiting. Pro tip: use a tight stop loss when scalping because it requires quick decisions. And be aware of spoofing, where fake orders are placed and removed to trick traders. Now, spoofing is frowned upon and technically isn't allowed, but it happens. Let's just say you add 10 contracts on the bid and you see something in price action that makes you second guess your decision. You might remove those 10 contracts because now you've lost confidence in that trade. Were you trying to trick someone? No. Could you have possibly tricked someone? Yes. Now you have to remember, a lot of these big orders that are being put into the market are actually being put in by real humans with real human emotions. If a big player decides to put on 100 contracts on the bid on GC gold futures, for example, but then here's fundamental news showing high strength in the US dollar, he may remove those contracts to see how price reacts first before making his trade. So just keep that in mind. Now, breakout traders use the DOM differently. Instead of watching for imbalances, they look for liquidity disappearing at key levels. This often signals that a breakout is coming. Here's how breakout traders use the DOM. They identify a key resistance level where price has struggled to break above. They watch the axe side for large orders stacking up, but they don't enter yet. If those large orders suddenly disappear, it means sellers are pulling liquidity, allowing price to break through. For example, price is near 4,200 on the ES futures contract and keeps rejecting. You see 3,000 contracts sitting on the ask at 4,200, blocking price from moving up. Suddenly, those orders vanish, and market buyers aggressively hit the ask. You might enter along as price explodes through 4,200. Now, reversal traders use the DOM to spot absorption and iceberg orders. This tells us when a big player or institutional trader is trying to hold price at a certain level. Here's how it works. Absorption. When aggressive market buyers keep hitting the ask but the price doesn't move up, this means that a hidden seller is absorbing those buy orders. Now, iceberg orders. These are hidden limit orders placed in small chunks. A level may only show 500 contracts, but those get filled and more contracts appear, meaning a big player is defending that level. When you see repeated absorption, that shows signs of a potential reversal. For example, price is moving toward 4,250 and aggressive buyers keep hitting the ask. Even though 5,000 contracts have been lifted, price isn't moving. There is a big seller absorbing them. So you might enter a short anticipating a reversal and price drops. In the next video, I'll show you a powerful tool you can use to identify those iceberg orders and absorption. Alright traders, now you know 3 powerful strategies using the DOM. Scalping by following bid and ask imbalances and aggressive order flow, breakout trading by spotting liquidity disappearance at key levels, and finally reversal trading by identifying absorption and iceberg orders. If you are new to the DOM, I recommend watching it on a sim account before trying to trade it live. It takes time to develop a feel for how order flow moves, but once you do, it can be a game changer for your trading. Alright traders, now that you know how to read the depth of market and use it to spot real-time buy and sell pressure, let's recap. The DOM shows us bid and ask orders waiting to be filled. Large stacked orders can act as support and resistance levels. Watching liquidity disappear can signal breakouts or fakeouts, and combining the DOM with price action gives you a massive edge in futures trading. Now, you might say to yourself, the DOM looks great, but I might not be able to remember what numbers were at what price. Or you might say, I've watched it and it just moves too fast. Well traders, don't worry. In the next video, I'll show you a powerful tool that you can use right alongside with the DOM that can actually show you what exactly happened at those levels, called the footprint chart. It's one of my favorite tools. So before you go, let me know in the comments, do you use the DOM in your trading? If not, will you start now? And if you found this video helpful, smash that like button, subscribe, and I'll see you in the next video talking about the footprint chart.